Good day, ma'am and everyone. We are the Group 6 and we are tasked to report the Lesson 2, which is the investment risk. But before we start, let me introduce to you my group mates, Cherry and Domingo, John Dave Iniba, Ivy Kitoriano, and yours truly, Rocky P. Pakbako. To understand better, let us first define risk.
So what do we mean if we say risk? Risk is the uncertainty about the size of future returns on a principal amount of money invested. This may mean that the actual return is less than the expected return. In short, risk refers to the hazards to which investments are exposed.
Kinds of investment risk. The first one is the systematic risk. It is a term given to forces that uneconomic, political, and sociological nature that are beyond the control of an individual firm. Under systematic risk is the inflation risk or the purchasing power risk. It is the factor affecting all securities or the chance that the purchasing power of invested peso will decline. Here, with uncertain inflation, the real return involves risk even if the nominal return is safe. The second is the interest rate risk. It is the variability in securities return resulting from changes in the level of interest rates. Interest rate risk affects bonds more directly than common stocks. This is the major risk faced by all bondholders because as interest rate change, bond prices change in an inverse direction. And lastly is the market risk. It is the variability in return due to fluctuations in the overall market. This includes a wide range of factors such as recession, war, and changes in consumer preferences.
Thank you, Mr. Pakpako, for sharing your thoughts about the systematic risk. Now, I'm going to discuss to you or share to you what is unsystematic risk. Unsystematic risk is a unique to every company or sector. So, unsystematic risk can be also known as unique risk or residual risk. Unsystematic risk can be decreased also through diversification of investment portfolio. Under the systematic risk, we have business risk and financial risk. So, business risk refers to the unpredictability of a company's profit as a result of changes in revenue and operational cost. It refers to the company's incapacity to maintain its position and grow of its earnings. And we have the two kinds of business risk, which is the external business risk and internal business risk. External business risk, the result of operating activities imposed upon the firm by economic circumstances such as business cycle, domestic and foreign competition. Next, internal business risk. This is largely associated with the efficiency of the firm to conduct its operations such as management decisions, labor relations, and the development of new products. And now, we're going to the financial risk. Financial risk. This is related to how a company finances its operations, which is normally identified by looking at its capital structures. It is a risk that arises from a debt being included in a company's capital structure. This can be traced back to utilization of borrowed funds or the concept of financial leverage, or the debt financing to amplify the effects of changes in operating income or the return to stockholders. It also means that there is a chance that payments you borrowed money won't be made or will be made at a loss.
Thank you for that discussion about the unsystematic risk, Ms. Domingo. So guys, let's move in the other source of risk. But before that, I just want to introduce myself. I'm John Dave Iniba. So let's begin. The first one is the default risk. It arises when the issuer of bonds is unable or unwilling to pay interest when promised or pay off the face value at maturity. The second one is the liquidity risk. This exists when certain bonds are not readily marketable and price distortion happens in the entry or exit of investment. The third one is the political and regulatory risk. It arises from unforeseen changes in the tax laws, changes in government policies, and corruption. The fourth one is the callability risk. This risk arises from the variability in return caused by the forced sales of bonds. Many bonds contain a call provision that allows the issuing firm to repurchase its bonds at a stated price and date. This call provision can adversely affect the value of the bonds if interest rates decline dramatically. The last one in the other source of risk is the convertibility risk. This kind of risk arises from the variability in return experience once a bond or preferred stock is converted into common stock. That's all of my discussion for the other source of risk. Thank you.
The last part of this video is the risk and return relationship. Now, let us discuss what is this all about. There are many different investment programs that we can invest in, but they all have different returns. As we go further, we will find why is this the case. First, let us know what is risk and how it affects the return on investment. An important principle of investment is a higher return entails higher risk. Risk drives the return of assets. Fixed deposits or bank deposits earn the lowest return because they are considered the safest. And shares of stocks have the higher expected returns because they are considered the riskiest. And investment bonds expected return lower than shares because they are less riskier than shares. Always remember that in investing, there is no reward without risk. For you to know what's best or fit for you to invest in, you should know or understand your risk appetite. Assess your risk appetite on 3 dimensions, which are needs, ability, and willingness to take risks. And that's the end of our topic. We hope that you have understood and gained knowledge about investment risk. Once again, we are the Group 6. Keep safe and have a good day. The key to successful investing is the ability to stay invested.